Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, Russ Kinnel discusses large growth funds, Dan Satiroff answers questions about the performance of foreign stock funds, Damian Conover shares his outlook for the healthcare sector, Dave Meets covers how energy stocks performed in the second quarter, Aaron Lash finds opportunities in the consumer defensive sector, and Brian Colello unpacks how the technology sector rallied in the second quarter. Let's get started. Here is Christine Benz from Morningstar Inc. and Russ Kinnel from Morningstar Research Services.
Hi, I'm Christine Benz from Morningstar. The first half featured extreme market volatility as well as extremely varied performance from mutual funds. Joining me to provide a recap of the first half in mutual funds is Russ Kinnel. He's Morningstar's Director of Manager Research. Russ, thank you so much for being here.
Glad to be here.
Russ, let's just talk about performance in the first half. It sounds like we just continue to see kind of more of the same, where we have very strong performance among large growth names as well as weak performance among small value. Let's talk about how stark the differential has been.
Yeah, it's kind of an amazing year because we had a rally into February. Large growth beat small value. We had a massive sell-off late February to late March. Growth beat value, and then a big recovery and growth beats value. So put it all together, and large growth is up about 6% for the first half. Small value down about 24%. So really just a record gap between large growth and small value. The rest of the style box somewhere in between there. Growthier better than value, large better than small.
So let's drill into the reasons for that performance gulf. I think most investors know well some of the large growth stocks that have really been pacing that portion of the market. But what's going on in small value and in that whole value column of the style box overall? What's holding that area back?
Well, one way to look at it is small value has a lot of economically sensitive companies. So when you have this economic shock where things are going really strong or almost what might be considered full employment, and then severe sell-off, all of a sudden, all these small value companies were hit. So you think about energy companies, financials, travel stocks, a lot of restaurant stocks, retailers. So a lot of small value names were hit really hard, and we've seen bankruptcies, and most of the bankruptcies are in small and mid-value companies.
So when you look at fund performance, let's talk about some of the value funds that we like, that your team likes, that have really struggled in this environment.
Among the perennial favorites, Oakmark really stands out. Both their domestic and their foreign funds have been hit very hard. The domestic have a bit of an energy tilt. The foreign have had a little too much in financials, and neither one had much in health and tech. So you put all that together, and they've had a very hard first half.
And I understand some deep value funds have struggled as well.
That's right. Hotchkiss and Wiley has done particularly poorly across the board. A lot of their funds came into the year overweight energy, and the funds have just really been crushed, and they're getting a lot of outflows. Longleaf Partners, maybe not quite as deep value as Hotchkiss, but a lot of deep value kind of names, and they've also had a very difficult year.
And you note that some of the prime cap funds have also struggled. Investors know them to be somewhat growth oriented, so I guess that's a good indication that not all growth funds have thrived.
That's right. In relative terms, the prime cap funds have done really poorly. As you know, they have a lot of healthcare and some tech, so those are good things, but they have a surprisingly large amount of travel-related stocks for a large growth shop. So this has been a very hard year for them. They're in the bottom decile in all of their funds. Obviously, the long-term results are still great, but it shows that even the best funds, I think, can be flat-footed by a market like this.
Okay, moving over to the happy side of the ledger, funds that have done really well during this period. Let's talk about some of those.
Yeah, so in absolute return terms, Alger Small Cap Focus and Morgan Stanley Institutional Growth, those are funds that are very heavily tech and healthcare. Morgan Stanley particularly likes a lot of the big internet names. So those have done particularly well. In relative performance terms, a couple good value funds, FPA International Value because it's got a lot in cash. Royce Special, which we've talked about over the years many times, is a longtime favorite. It's a very defensive fund with Charlie Dreyfus emphasizes clean balance sheets and other characteristics. So sure enough, it's lost much less than its small value peers this year.
How about fund flows, Russ? It seems like we've just been seeing this avalanche of outflows from active funds. My guess is that is not getting any better here in 2020, but can you kind of summarize some of the trends that you've been seeing on the fund flows front?
Yeah, it's really been an interesting, very fluid situation. In March, we actually had more money going out of bond funds and stock funds. But and of course, March, a lot of that sell-off came late in the month, so that may be why. But then in May, we saw accelerating outflows from equities and inflows into fixed income. In fact, May was the worst month for equity flows since 2009. So it's really hard to say where do we go from here because, of course, the markets have rebounded some, but as we mentioned, values still hit pretty hard. So obviously, if we have a sustained outflows, that could be pretty tough for a lot of active equity.
Okay, Russ, always great to see you. Thank you so much for providing your insights today.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Now, Dan Satiroff from Morningstar Research Services.
Hi, I'm Christine Benz from Morningstar. The year 2020 has been a volatile one so far for investors, and that includes investors in foreign stock funds. Joining me to provide a recap of the first half for foreign stock fund investors is Dan Satiroff. He's a passive strategies research analyst for Morningstar. Dan, thank you so much for being here.
Hey, Christine.
Dan, let's get right into performance and talk about how foreign stock funds have performed relative to U.S. stock during the first half so far.
Well, generally, they haven't performed as well. You kind of got to break it up into a couple areas, right? So we're filming this, it's June 25th right now, right? So if we're looking back from January 1st, more or less through the first half of the year, foreign stock has sort of lagged the U.S. by a little bit. That hasn't really been all because of, typical things like you would think, like the dollar has continued appreciated. That's hurt it a little bit, but it's really just been the local market stock returns that have kind of hurt it. They've underperformed by, around 6 or 7% in aggregate. And that's sort of just a continuing story of what we've seen over the past 10, 11 years. Foreign stocks have generally lagged their U.S. counterparts pretty broadly.
And some of the issue may simply be that there aren't FANG equivalents overseas, that's part of what's been driving the U.S. market, and those big technology names are not necessarily leaders, or there aren't analogous leaders in foreign indexes, correct?
Yeah, that's right. When we did the analysis, and I've got something that's going to be published here in a few weeks, but when we ran the numbers, the continuing story I kind of hear is that this is kind of a sector play when you look at sector differences across countries. And that's certainly true. However, the sector differences didn't really account for a lot of the return difference when you ran an attribution. Really what it came down to was what you're saying. It's really the individual companies in the U.S. Versus their foreign counterparts that are really are really responsible for a lot of the performance gap. So, in the U.S., we've got like the Microsofts, the Apples, and Netflix that have had really strong performance over the past decade. And they just don't, like they're U.S. companies, they don't exist overseas. So that's been a big part of the gap between the U.S. and foreign markets.
Let's drill into various subsectors within foreign markets, starting with value versus growth. In the U.S., we've obviously had this long-running bifurcation with growth stocks dramatically outperforming value. Does that carry over overseas into those markets as well?
Oh, absolutely. And we've seen it in the first half of this year as well. Value stocks have just gotten trounced, and growth has actually held up pretty well. And the performance from overseas growth stocks has actually been comparable to the U.S. market. we've got a couple funds that track those indexes, or shouldn't say track those indexes, but they follow those styles. And they've held up, consistent with what you would expect from that sort of performance bifurcation, I guess, as you put it.
How about international small caps?
Small caps have had, they've been back and forth. Obviously these are high beta stocks, so they've generally performed pretty poorly over the past 6 months, which is kind of what you would expect, right? They're a little more levered to their local economies. They don't have sort of the competitive advantages of their larger counterparts. So their drawdown was a little bit steeper during the coronavirus sell-off, which is consistent with what you would expect. The other thing with small caps is they tend to have a lot more exposure to things like energy and materials. So those sorts of sector plays tend not to be great, especially when you go through sort of this energy drawdown that we saw, coinciding with the coronavirus sell-off. So they've had a tough go of it over really the past 6 months and really over the last few years as well.
How about the low volatility strategies? I know a lot of investors have gravitated to them for the expectation that they would hold their ground in an environment like what we had in the first quarter. How did they hold up during that difficult period?
They did a little bit better. They, again, consistent with what we saw in small caps, they did kind of what you would expect. They took some risk off the table. Their drawdowns weren't as deep. Realize it's kind of a shallow statement when you went through a drawdown as big as we saw during the first quarter. But they generally did. They took some volatility off the table. Their drawdowns weren't as deep, and they delivered as intended and as promised. So as far as validating their thesis, they did exactly what we would have expected them to do.
What are you seeing with fund flows in a period in which foreign stocks have underperformed U.S.? Are we seeing investors take some chips off the table there and sell foreign stock funds?
Yeah, over the last 2 to 3 months, we've actually seen some pretty big outflows in foreign stocks broadly. That includes both developed and emerging markets. What's interesting about this sort of outflow over the past few months is that for the past, I'd say probably 10 years or so, you've seen a lot of movement out of active and into passive strategies. This outflow really, it didn't really matter. Investors were pulling money from both active and passive strategies, almost depending on the market you were looking at. It was sort of equally weighted between the two. So it really, to me, says this is sort of a risk-off sort of outflow type thing. People, I think, are just sort of getting fed up with the poor performance from foreign markets. At least that's what the data would seem to indicate.
Well, that's what I'd like you to speak to. I think you're right that a lot of investors do feel a little bit fed up with their foreign stock allocations. It's been quite a while since we've seen foreign stocks outperform U.S., at least for an extended period. So, how do you counsel investors to think about this and to keep the faith in a globally diversified portfolio? What's the case for foreign stock holdings at this point?
It's really tough. I'll agree with you. The performance has not been great. It's been a very, very long slug of just underperforming the U.S. market. It's difficult to justify, understandably. But I always remember that, markets can't go in one direction forever. Sooner or later, valuations have to come into play at some point, right? So right now you've seen foreign markets underperform for over a decade. Their valuations are understandably lower than they are in the U.S. I'm just following a strictly balancing strategy. So on that, like we say every time we sit down for these videos, I'm going to be buying more foreign stock when I go to rebalance my portfolio. And, over the long run, the next 20, 30 years, whatever your time horizon is, I think that's going to be a pretty good strategy. It's worked out historically, and I'm very confident that it's going to continue to work out very well in the long-term future.
Okay, Dan, great points. Always great to get your perspective. Thank you so much for being here.
Thank you, Christine.
Thanks for watching. I'm Christine Benz from Morningstar.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed. Next, Damian Conover of Morningstar Research Services shares his outlook for the healthcare sector.
Today we're talking about the outlook for the healthcare sector. And the sector's had some nice performance over the trailing 12 months. It's up close to 12% versus the overall market, which is only up about 8%. And a lot of this has come just in this recent rebound in the second quarter as the investors have felt more confident in the overall market getting through the challenges of the coronavirus. For healthcare specifically, I'd call out three key fundamental factors driving some of the returns. First off, we're seeing good underlying fundamental research and development that really drives a lot of the stock returns for these different companies. Second, these companies are very well positioned moving into potential policy reform. So in the United States, as we come closer to an election, there's always concern that new potential elected officials could make major policy reform. With Joe Biden, the likely Democratic nominee for president, it's likely that either he or Trump will probably not institute major healthcare reform, which is probably a good thing for stocks within the healthcare sector. And then the last point I'd make here is that within the coronavirus, there is a defensive nature of healthcare companies. And these companies should hold up reasonably well despite any of the economic fallout from the coronavirus. From a valuation perspective, we are looking at the healthcare sector right now as slightly overvalued. However, we do see more attractive valuations within the large cap pharmaceutical stocks and the managed care organizations. What I'd say about the large cap pharmaceutical stocks in particular is these companies tend to do very well regardless of the economic backdrop. And within the coronavirus challenges, people are still going to need to take their medicines. We think two companies in particular are well positioned, Bristol Myers and Merck. Both of these companies focus on oncology drugs. These are drugs that people will put a high priority on getting, and these drugs tend to hold up very well with pricing power. One of the last notes I would make here is when we think about the challenges of the coronavirus and we think about the companies that could help get the world out of these challenges, the large pharmaceutical companies are really some of the key players in this ability to return us back to normal. In particular, there's a lot of vaccine development going on right now. 5 leading companies are all from the large pharmaceutical companies. And while these companies have messaged that they don't anticipate charging very much for these vaccines, so we don't think they're going to get a lot of cash flow from vaccines, these firms will likely be able to redeploy the goodwill generated from bringing out a vaccine to the overall market. And that, again, will likely reduce the challenge that some of these firms face in pricing drugs outside of the coronavirus. And this goodwill, we think, will help strengthen the overall pricing power for other drugs and really uplift the wide moats that we see in the large pharmaceutical space.
Now Dave Meets from Morningstar Research Services covers how energy stocks performed in the second quarter.
The outlook, Brian, for energy stocks in the second quarter, Morningstar's U.S. Energy Index gained 28% as at the end of March, as compared with a gain of 18% for the broader U.S. market index. And oil prices essentially doubled in the same period. But by and large, the energy sector still looks cheap even after this rally. On the supply side, OPEC and its partners have U-turned after kicking off a price war back in March and have now pledged substantial production cuts, collectively withholding almost 10 million barrels a day from the market. Compliance with those cuts isn't perfect, but the initiative still makes a big difference and should help right-size crude inventories over time. And on the demand side, we think reduced social distancing combined with unprecedented fiscal stimulus should support further recovery. So the U.S. shale industry will remain a key component of the global crude supply stack. And the shale business model doesn't work at current oil prices. We think prices must recover to incentivize producers to keep drilling. As a result, we see value across the entire energy complex, but the most undervalued sector is oilfield services. Upstream firms will have to increase capital spending in the next few years to offset worldwide production declines, and the market isn't giving oilfield service stocks enough credit for that. Our top pick is Schlumberger, which has a 5-star rating and a narrow moat.
Expand your investing horizons and look to the long view with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Next, Aaron Lash of Morningstar Research Services finds opportunities in the consumer defensive sector.
Consumer defensive lagged the broader market's impressive rebound this quarter, generating a nearly 12% return compared with the market's more than 20% gain through June 23rd. But we think the space has become more heated. More specifically, the median stock in our coverage now trades at just a 1% discount to our fair value estimates, which is a sharp acceleration relative to the 14% discount the space boasted 3 months ago. We think this partly reflects recent top line acceleration as consumers rushed to stock their pantries with essential fare. In this vein, consumer packaged goods and non alcoholic beverages offered bargains at the outset of the pandemic in the US, but shares have since rebounded. As consumers switched to stock up trips with larger basket sizes, out of stocks or limited supplies of certain items were common in the US. And in response, manufacturers halted previously slated promotions. But as the initial buying surge has waned and lockdowns lifted, items sold on sale have begun to edge higher. We think promotions may persist if a prolonged economic recession ensues. However, given a lack of switching costs, we think investments in R&D and marketing will be crucial to ensure brands and retail relationships aren't impaired and consumer visitation to aisles throughout the grocery store persist. But we still expect retail purchase trends will decelerate to the low single digits over the longer term versus the high single digits to double digit clips many consumer packaged goods operators have posted in some historically staid categories throughout the store the past few months. From our view, opportunity in consumer defensive can be found in tobacco and alcoholic beverages, which each trade at 15 to 25% discounts to our assessment of intrinsic value. While the challenges plaguing tobacco are well understood, reflecting continued volume erosion, we think alcoholic beverages came under pressure more recently as on premise consumption ground to a standstill, with bars and restaurants closed due to the COVID-19 pandemic. Although we expect a near term sales hit, we don't believe this stands to impair the brand intangible assets and cost advantages underpinning moats in the space, and believe the recent retreat is creating an interesting opportunity. In this vein, we'd call out Anheuser-Busch InBev. Simply put, we believe the stock is attractive, trading about 50% below our intrinsic value assessment. Although sales have taken a hit from coronavirus disruptions, we expect revenue to pick up when social distancing guidelines are relaxed, given about a third of sales result from on premise consumption, with growth rebounding to the high single digits in 2021. AB InBev is the most leveraged among the brewing group, but we think the firm has sufficient liquidity. We believe it is well positioned for the long term, with monopoly like positions and cost advantages in developing markets that continue to generate value. Further, we think investors interested in the space should look to No Moat US Foods, which trades around a 40% discount to our intrinsic value. Consumers have avoided away from home food consumption since the start of the pandemic, hampering operators throughout the food service industry. But despite the hit to sales, we expect US Foods growth to gradually improve in the second half of 2020 as consumers revert to prior habits, and don't believe the slowdown has negatively altered its liquidity profile. Although we ratcheted back our fair value estimate for US Foods by 17% since the pandemic struck, shares are down more than 50% year to date, creating an attractive margin of safety.
And lastly, Brian Colello from Morningstar Research Services unpacks how the technology sector rallied in the second quarter.
Similar to the broader market, technology stocks have been on a wild ride over the past 6 months. As of June 5th, the median technology stock is about 8% overvalued, in our opinion. Now, at the start of 2020, prior to the COVID-19 pandemic, the median tech stock was about 11% overvalued, and valuations were as frothy as we've seen since 2007. Now, with the sell-off at the end of March, at the depths of the COVID sell-off, tech was 20% undervalued. So the sector has really rallied back to again now be 8% overvalued. Comparing tech to the broader market, tech is a clear outperformer. Over the past 12 months, again as of June 5th, tech is up 37.6%, while the US equity market index is up only 12.5%. We've seen a big rally in software names, and some tech firms have been counter-cyclical to the market and have been winners in this work-from-home trend. The median software stock is 11% overvalued, but business conditions have held up relatively well. Growth will somewhat be slower in 2020, as you'd expect, but we think business conditions bounce back in 2021. Employees still need access to the software while working from home. Remote working will likely continue to be adopted, which is good news for companies like Zoom, Microsoft, Slack, DocuSign, and some others, but we think valuations are rich. Cybersecurity is also seeing a boost in spending, especially for cloud vendors like Zscaler, Okta, and CrowdStrike. Across technology, we think hardware names are a little bit cheaper, but generally aren't as moaty and don't have the sustainable competitive advantages that we see in higher quality software or semis or cybersecurity. Those names are a bit expensive, but names that we do like are Palo Alto Networks, VMware, and Cognizant Technology Solutions. Looking ahead at earnings reports in July, we'll be keeping an eye on business conditions in software and cybersecurity. We'll be looking for any signs of delays, deal cancellations, lower pricing, anything of that nature. In semiconductors, some end markets have been strong, others have been soft. Data center spending has been a bright spot, and we'll see if that continues.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision. That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.